are epic, 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 epic. Once again, we meet for actually today it's a special edition. So we're meeting for an NFP analysis, fundamental analysis. And then today we're like, no, let's just do it just a few hours before NFP so that people can grasp it and they can have a clear mind, you know, when they're approaching the market. So it's going to be quite incredible. It's going to be very, very, very interesting. And we're looking to do the most today. Actually, I was even thinking, which is something that I might do, might have a live trading session also with NFP after this session. So around there, around 2:30 or so, we might have a live trading session. And then it's going to be interesting. It's going to be epic. So guys, please, let's have our pens and papers. Let's always have the pens and the papers. You see, let's always have the notepads. Notepads must be kept quite near. And then, you know, from there, you do what's necessary and we execute. So guys, it's going to be something quite epic. Mr. Tumisho is with us and he'll be taking us through, you know, what he has analyzed fundamentally and what will affect what in what way. So guys, very epic. I'm quite interested. I'm very happy to be here. So Mr. Tumisho, please sir, lead us.
Oh, thank you so much for the beautiful introduction. Guys, my name is Tumisho Ramadisa, as Mr. Ben has alluded to. And yes, we're going to go deep into this fundamentals because NFP is right here. It's a few hours from now. So yeah, let's see what we can dissect here. Let me just share my screen. Okay, I'm assuming everyone can see my screen at this point. Okay. So welcome again. Just started from the beginning. Just waiting for the screen to load the slideshow. Okay, here we are. So NFP and unemployment, very, very interesting topics. We always deal with these ones at least once a month. So we always have these sessions. So we'll be looking at key economic indicators to observe, as well as manufacturing employment, initial jobless claims, ADP employment change. By the way, initial jobless claims as well as ADP employment change came in yesterday. So just fresh in our memories for those who witnessed the news event, right? ADP and initial jobless claims. And then to end the session off, we'll look at the 10-year yield, the 10-year government bond yield. Now, non-farm payrolls, the previous number was 114K, which was a huge drop from the month prior to this prior month, if that makes sense. The July numbers were very high, and then the August numbers came in at 114K, which was like significant. It was a big thing in the news, right? So now the forecast is for 164, but do notice that for the majority of the year, we've been running at about 200 to 300K, around that range, job creation, right? And what is happening here is that we are at the 100Ks, which means employers are not producing as many jobs as they naturally do, because especially when you account for population growth, right? Population is always growing. And as a result of this, you should expect these numbers to have a natural baseline to the upside, which it does. But when it shows you divergence from that baseline, right, let's just say the natural baseline for unemployment is 300K. So we always get 300K as a jobs. As the years go by, population increases, and so the baseline has to increase as well to maybe 350, 400K in a few years' time. But when you see it at 100K, it's always an emergency bell that should be ringing in your head to tell you that something is really wrong with the economy. And we've been predicting a recession for the whole year since we started these fundamental sessions. You guys were aware of my recession prediction, and right now we are seeing some of that come into fruition, and slowly but surely the chickens are coming home to roost, right? Now, unemployment rate 4.3 the previous month. We have a forecast of 4.2, which is lower than the previous month. So what these guys are saying is that unemployment is supposed to be good, right? And there's many good reasons why these forecasts exist in this manner. Now, there is some contention with the unemployment rate because I do not see the forecast. I do not see it hitting 4.2. I think it will crash 4. I think it will go, it will stay at 4.3, which is the previous month, but if that's higher than the forecast. So nonetheless, let's just check into the chart to confirm our biases. When you look at this chart in blue, we have ISM manufacturing employment. So ISM manufacturing employment has rebounded from its May, since it started going down in May. It has rebounded since its 2-month woes, if you would call it that. And this is telling us something, right? As you can see, non-farm payrolls are highly correlated to ISM manufacturing employment, with divergences happening on a monthly, with divergences only happening on a quarterly basis. Like what you see here is that in March, since from March to April, the April numbers came out where you find that non-farm payrolls went down, but ISM continued to go up. Like if we see this divergence, right? This divergence here is telling us that's okay, it's not 100% correlated. However, the correlation still exists because the months prior, it was moving in the same wave. As you can see, since November 2023, as we enter to 2024, though it's been moving in the same direction, except for that 1 month in March, from between March and April, right? And then in May, it came back. It followed. It means ISM was a true indicator at this point because non-farm payrolls followed ISM. It went back to the trend. It went back to the correlation, and it continued this correlation from May into June. And what we're seeing here is that will this correlation continue to flow, or will we see another divergence? I do not think so when you consider the fact that these economists are predicting an increase in jobs from the previous month. On top of that, they're saying that unemployment is going to be lower than last month. So they're seeing a rebounded labor market, which makes sense because the labor market doesn't go down in a straight line. However, again, what does this mean for the unemployment rate? It means they said that the previous month was 114, and the economists are predicting something 164K. So we had 114K the previous month, and they're predicting 164K, which is significantly higher than 114K. And what we can deduce from that is that most likely unemployment will go up. I mean, not unemployment, non-farm payrolls will increase from the previous month relative to the previous month. However, will it push higher than the forecast? If it pushes higher than the forecast, it would mean that the economy is actually the labor market has truly rebounded. I do not think it has truly rebounded. Therefore, it would be safe to say that the chances of unemployment, or the chances of non-farm payrolls going higher than the forecast, is significantly lower. However, we are guaranteed that the non-farm payroll numbers is going to come out higher than the previous month, which is showing a bit of a rebound. But the market, if it doesn't go higher than the forecast, the market is going to take that as a negative for the dollar in the short term. In those few seconds when the news comes out, the market should take that bearish for the US dollar, right? Now, unemployment benefits is also telling us something. What I've done with this chart is I plotted unemployment rate with initial jobless claims because first of all, they follow each other because they both referring to the same things. When people are filing for unemployment benefit, you assume that they are unemployed in the first place. So naturally, these two indicators should follow each other, and we can see it does follow each other, although there is a bit of noise with initial jobless claims because unemployment comes out once a month. Initial jobless claims comes out about 4 or 5 times a month, right? 4 times a month. So this means there is going to be some noise. However, we could use the unemployment rate as a trend line. We could basically use it as a trend line for initial initial jobless claims. So the main thing to really focus on here is initial jobless claims, because whatever happens to initial jobless claims will impact the unemployment rate. And they're saying, these economists are predicting a decrease in the unemployment rate. And what we have seen here with initial jobless claims is that the numbers have certainly failed, right? The numbers have certainly slowed down a bit, right? As you can see. And this means because the numbers have went down a bit, like as you can see here, since near the beginning of August, right? We see this little decrease here. And this little decrease is telling us that less people are filing for initial jobless claims, less people are filing for unemployment benefits, which should tell us that less people are being unemployed, which makes sense why these economists would predict a 4.2% unemployment rate, which is lower than the previous month of 4.3%. Now, this increase, we have to also take into account the fact that the unemployment rate stopped here. So when we are looking at where the unemployment rate may head in the future, we have to consider this whole picture, right? Let me just draw it better for you guys so you can see it much clearer. Okay, so if you look at this, right, this box right here, this box is telling us, okay, it's basically break even. If you consider these 2 months, I mean, it had a swing to the upside and a swing to the downside in the month of August. However, due to these swings, we can deduce that the safest bet here would be unemployment rate to remain flat, right? Unemployment rate to remain flat, because it went up in July, but then in August it went down, unemployment benefits. So there's a bit of it's a bit of a break even kind of situation here. So that's what we should take into account, which means that the unemployment rate, if it came out at exactly 4.3, that would be, if it didn't go down to 4.2, it would be heavily bearish for the US dollar. And let's just assume this, right? The economists are predicting 4.2, a decrease in unemployment rate. If the numbers come out at 4.2, it means it basically has zero effect on the US dollar, because it's basically as it was predicted. It came out as predicted. It didn't come out lower than expected or higher than expected. However, if we get the same numbers as last month of 4.3%, which I think the probabilities is higher for it to come out at 4.3%, due to the fact that initial unemployment benefits have remained stagnant. They haven't really had a big swing, right? They haven't had a big swing since the last unemployment rate. So this is telling us something very, very interesting, right? And we should keep this in mind. If it comes out at 4.3%, it would be bearish for the US dollar. On top of that, you have non-farm payrolls coming out higher than the previous month. However, still below the expected of 164. If we get a scenario like that, then we could see the dollar tank, right? In the short term, in those couple of seconds, so to speak. Okay. Now, private jobs is also very interesting, because what we see here in purple, we have non-farm payrolls, and in orange, we have ADP, and these two indicators are correlated historically. They have a very strong correlation. I would say they have a plus or minus 50% correlation, positive correlation, right? A 0.50 correlation coefficient. I have done my study of this. I would like to post it in a separate Zoom meeting, but I did also dig in and went through some of the statistics here, taking it from 2015, and what I found was that the correlation coefficient is greater than 50% for ADP, right? Plus or minus 50%. We can put it at that. So the correlation is extremely high. Plus or minus 50 in statistics is a significant correlation. In fact, if the correlation was 0.70, we don't usually get correlations that are greater than 0.70, 70% positive correlation, because nothing is really the same. That you can't find two indicators, two variables that are 100% the same. Like, it is near impossible to find something like that in anything, right? You could quantify it in any ways, and it's very hard to get such a correlation coefficient of greater than 70. Although in the social studies, apologies for that. Although in the social studies, we have instances where that is the case. My bad, guys. I'm just fighting this flu, eh? But yeah, so private jobs are declining. In fact, the last number that we got was a decline. My bad. However, it was a smaller decline than the previous month. If you see the previous month was a massive decline. If you see this chart right here, right here, massive decline. And so non-farm payrolls followed ADP to the downside. And now, will non-farm payrolls increase from the previous month? Most likely, it will get an increase, or it will remain flat at 114K. However, the probabilities that it will go down is significantly lower because ADP did not go down that much. In fact, ADP was nearly the same as the previous month, which means non-farm might have a stronger market push, might have a stronger Fed put, and we might see non-farm payrolls flat. But due to ADP, the economists are predicting 164K jobs. 164, economists are basically predicting that that non-farm payrolls are going to move like this. They basically, because this is 160. This is 160 right here. So economists are basically predicting that it will go up that far. But when you look at ADP, ADP says it won't be a very noisy employment. We won't get a very noisy employment rate. We won't get a very noisy non-farm payroll due to the fact that we haven't seen that momentum in private jobs. We haven't seen the same, when you couple that with initial jobless claims, we did see momentum in August. However, we did not see momentum as much in July because these indicators are very much telling us that the probabilities that non-farm payrolls come out significantly higher than the previous month is very low. However, an increase might be reasonable from the previous month of 114,000 jobs. So that's something to be aware of. So right now, we can see that our bias is clearly a dollar bear, right, just based on these numbers. And when you look at government bonds, right here, we have the 10-year government bond versus the 3-month government bond. By the way, government bonds, again, this is the yield on government bonds, right? When you see this 5.4%, 5.3, 5.2, 4.8, this is interest rates in the real economy. Government bonds, basically, they have a price and they have a yield. A yield is an interest rate. And what we're looking at here is the yield. The yield is inversely correlated with the price. Because we have repeated this several times on our sessions, but for those who are only joining us now for the first time, it is good to know that, right? And what is happening here is that this makes sense because, right, how does economics work? You have price, if the price goes up, the yield goes down. If the price goes up, it means there's demand for government bonds. Government bonds are safe and liquid assets, and therefore they are in high demand during recessionary periods and they're in low demand during economic growth. When the economy is growing, you don't want to invest in a safe and liquid asset. You want to take more risk. Buying government bonds is being risk averse because the government can never go bankrupt. So there's virtually zero chance that you will lose your investment on a government bond due to the fact that the government does not go bankrupt. But because of this safety net, the interest rates on government bonds are lower than interest rates on, let's just say, corporate bonds, right? Corporate bonds, things that also yield higher interest rates, like actual credit that is being given out by these banks, things like that. In investments on homes like real estate yield higher interest rates. Yes, they have higher yields, and they have higher yields because of risk. The higher the yield, the higher the risk, because if you are getting a higher interest rate for something, then that means that is the asset's way, the asset's way of compensating for risk. So the higher the interest, let's just say you get a house, you know, if the interest rate is higher, then the risk is higher, right? If you to make more money, it actually makes sense intuitively. The more money you make, the more risk, right? More risk, more reward. And that is an economic fact because when you look at government bonds, that's exactly what it's telling us. But nonetheless, sorry for going off a tangent there, but what we are seeing here is that there's a decrease in government bonds. Look at this. Since May, June, July, we've seen, in fact, since July to August, we've seen a massive tank. And at this time, we had a lot of entities failing. Bankruptcies have increased. In fact, they're up 10% in the United States. So bankruptcies is a very, very interesting one to look at. They're up 10% month to month for the month of July, which is telling us that this is what the government bond yield is saying. So when government bond yields are low, it's telling us that there's economic problems, there's economic distress, and therefore, due to this economic distress, it means the dollar should be under attack over the short term. It's telling us that not just the dollar, but unemployment. Unemployment, it's telling us about the whole economy because government bonds represents what the economy is doing. And when you look at this chart, if you see when you see these government bond yields dropping like crazy, it is telling us that the economy has serious problems. And therefore, I think the economists, just based on this data, the economist uh, predictions, the economist forecasts are too optimistic, in my opinion. And this leads us to the end of our session, guys. So thank you for sticking with us till the end of the session. If you have any questions, feel free to ask the questions. And I see the chat is a bit busy, so we will be taking these questions. Okay, let me just see these questions from the top and I'll answer them in chronological order. Okay. And guys, when you're trading this CPI, right, it's 11:30 right now. There is still time. There's still time to trade, guys. And here at Forex MG, we recommend AccuMarkets. We recommend AccuMarkets for just the best trading experience that you can find in SA. So please, guys, use AccuMarkets. The link is in the chat. Okay, let me get these questions. Oh yeah, it was a screen problem. Okay, thank you for the his. Oh yes, yes. Wow, that's amazing. That's amazing, Mr. Lebogang. Uh, okay, Dumza, yeah, it means most likely the dollar will be bearish. That's what I said. The dollar will be bearish, in my opinion, just based on these numbers. The dollar will be bearish. However, remember, NFP is not like CPI, You get you get something, you get bad numbers. However, the market just flips on you and you get a spike. You get a spike and then the market just reverses same time. So imagine you get in on a gold buy. If you're getting in on a gold buy, you make it quick. You make it quick because it could buy and then immediately crash same time and you only have 10 seconds to get out. So please be aware of that. Hey, Mr. Nkanyes. Hey, wisdom is chasing us. Hey, yeah, that's what we are here for. That's what we specialize in here at Forex MG. Wisdom chases us. Which is a very arrogant thing to say, but I mean, Mr. Nkanyes said it himself. I didn't have to say anything. I mean, the man said it himself. What about ISM services PMI? It's set to account for the economy. Yes. If you remember the first chart that I projected on your screen was ISM manufacturing employment, right? Now, services employment is doing the exact same thing. I just didn't want to repeat those two, right? So, which is why I picked manufacturing instead of services employment, not the PMI as a whole. Because we're dealing with unemployment, we want to we want to segment ISM and only use the employment data from ISM, from the Institute of Supply Management. Okay. Okay, so Dondan, no. The probability of a dollar bull is very unlikely, in my opinion. Due to the NFP numbers, it tells us that the dollar is strong. Due to based on the predictions, the economists forecast, they are saying that the dollar will be strong. However, I do not see that happening. I do not see that happening. Do you predict that the dollar will? Yeah, I think I've repeated that 1,000 times. Okay. Yes, Mr. Buikucho. We can buy. Yeah. Does ADP non-farm employment affect the NFP? Oh, 100%. ADP is correlated to NFP. The last chart that I showed, the second last chart was ADP versus ADP versus non-farm payrolls. Non-farm payrolls and ADP follow each other. I even went on a rant about that statistics correlation coefficient, whatever. And yeah, they have a strong correlation coefficient. So that's something to keep in mind. Um, okay, what is the probability? Yo, I would say nine out of, let's have a spike, 9 out of 10. 9 out of 10. Okay, guys, we have a few minutes. What are the main drivers for USD CAD? So if we deal with the United States, it's basically the global economy. So on the dollar side, it's the global economy. On the Canadian dollar, we're talking about oil because Canada is a large oil producer. So that's what's affecting the Canadian dollar, amongst other things, but just in a simplified manner. Ah, hey, you know these NFP spikes. 1 out of 3, 1 out of 3 NFP events do not have those crazy spikes. Let's just put it out there. 1 out of 3. Yes, Walter. In fact, I recommend trading after the release. In fact, yes, 100%. I recommend trading after because you have the numbers, and then all you have to do is cook your technicals, to get a good entry. But you have that fundamental because the news just came out. So 100%. My bad. Okay, so apologies for that. Hey, flu is dealing with me, guys, but yeah. Okay, got it. So yeah. Okay, so which means that the dollar is weak. Yes, 100%. If we assume that the if we assume that non-farm payrolls is lower than expected, because those expected numbers are too unrealistic. It's too much. 164K jobs from 114K. That is a stretch, in my opinion. So yes. Okay. Okay, so guys, I'll just take one more question and then we can close the session. Just two more questions. And yo, guys, the link is in the chats, guys. The link is in the chats. Trade with the best broker, guys. So we don't complain about off codes and other funny things that these brokers, these scam brokers in South Africa. So trade the right way, the AccuMarkets way, guys. Please visit our website, Forex AMG, guys. Please visit our Forex AMG website, and you will get all the information there for our packages that are available. Okay. I think we can end this now, guys. Thank you so much for tuning in, for listening to me. I did appreciate this session. Hopefully, we've learned something from the session, and we will trade accordingly. So I'll leave that with the Shire. Mr. Ben, yeah, any final words, Mr. Ben?
Of course, of course, of course. Excuse me. So indeed. Guys, what a beautiful session. I've taken down notes, like no one's business. We've been taking notes. So something quite epic. And yeah, I'm ready for NFP. I don't know about you guys. So I was thinking of hosting a live session for NFP. So I think it's something that you can be looking out for. Today might be hosting a live session. And then it can be quite interesting. Can be quite interesting. But yeah, that's what I'm looking to do today. We'll be hosting a live session, and then if anything, I'll send out the link here. And then, yeah, guys, let's do all that we can to make money through this NFP. My suggestion, the safer way you can trade NFP is to wait, let the first move happen, right? Usually there'll be a retracement, or if it's a spike, then go in the opposite direction. And in like 5 minutes after NFP, there'll be a good move, and it'll be one that won't trap you, and it will go in one direction. So really for NFP, I would suggest, okay, so this is what you should do in any ways, any day. You should always have a separate account with the money that you're willing to lose, like completely, money that you're willing to lose completely. And that is the one that you want to trade NFP with. So if you want to have an initial entry, enter same time, full margin, whatever, you can do it and you won't feel that pain. Because if you trade with your primary account and you trade NFP, you go all out, it can be something that's quite, hectic and bad. So guys, let's meet, yeah, 2:30. Let's meet soon. I'll let you guys know if I'll be hosting, and then yeah, we'll go for it, guys. With that being said, have a great NFP, go all out, have a great session. Let's make money. There's a lot on the table, and let's take it, guys. So please, thank you very much. Let's meet soon. We shall meet on Tuesday and Sunday for our technical sessions. And then, yeah, with that being said, have a great session, guys. Bye-bye.